Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. All eyes are on the SP 500 as it rallies here off its October low. A quick 10% rally here. A lot of people are thinking right now, and you go on Twitter, you go on YouTube, the overwhelming narrative out there is that bounces are going to be short-lived and you need to use every opportunity you can to get defensive because this is just another bear market rally, and you can understand where that pessimism is coming from. 60-40 portfolios. The performance in 2022 of 60-40 portfolios, so classic stock bond portfolio allocation, we've so far had the worst year-to-date return of the past 100 years, right? So that is absolutely insane because it includes the Great Depression. It includes 1929, 1930, 1931, which are historically known to be probably the most violent years to be in the financial markets. Well, if you take both stocks and bonds into account, 2022 has been worse than that. Let that sink in. And if we take a look at what bond prices look like today, you can understand where that underperformance is coming from. This is the inverse of the 10-year yield going back to 1913 right here. Now, the reason I'm showing you the inverse of the 10-year yield is because this is basically what bond prices look like over the long term. In fact, if you add TLT, which is the most widely known ETF of treasury bonds, you add it to this chart and you can see it looks the same, right? It's just that the ETF only started in 2002, so you can't actually see the data going back this far. So it's very interesting to see what the 10-year yield has looked like over the past 100 years. You can see this massive breakdown that we've seen in 2022, where essentially you've got the debt bubble that has popped. Now, this was extremely violent, right? An extremely violent move, in part because of COVID, some very unnatural financial market phenomenon. The last time we had a rising rate environment, it really started out very slow. But here in 2022, we've seen the treasury bond bubble pop within a year. This move has been absolutely monstrous. And if you think about why we've seen such a large underperformance in both the stock market and the bond market, the answer is very simple. Right? It's been about inflation and it's been about the Fed, right? Those two big factors, the fact that inflation has run hot and the fact that the Federal Reserve, the U.S. central bank, is determined to fight against inflation. And so not only has that popped the treasury bond bubble, but it's also brought the stock market down throughout this period in a significant manner. Now, what I'm concerned about is what effects this is going to have on the economy. Can the economy actually withstand this? This is the financial markets making a bet that the economy is strong enough to actually withstand rates that are this elevated. This could potentially have some pretty devastating impact on the economy down the road, but that's a question for another day. For now, the market is not being driven by the real economy. It's being driven by inflation. And this rally that we've seen so far off that October low is only happening because some investors are thinking this story that we've seen throughout 2022 that has caused the 60-40 portfolio performance to print the worst year-to-date reading of the past 100 years, that story is almost over. So the question that we want to ask in this video is whether these investors that are going and betting on the market right now, whether they're right about that. By the way, if you are so far enjoying this video, don't forget to smash that like button as hard as you possibly can. It really does help push out our videos. If you enjoy the presentation of the video, the cool charts that we pick for you guys, and the education we provide, it really does help the channel out when you smash that like button. Now, I'm going to show you a few charts here that hopefully are going to illustrate these concepts for you. Now, this is a chart that we used in one of our recent articles that was called A Massive Interest Rate Shock, which I strongly recommend you go ahead and read if you want to fully grasp what's happening in today's market environment. But what this indicator essentially is, it's supposed to be an underlying inflation gauge. And it's actually an indicator that's produced by the New York Fed. You can see very visually right here, there's not much back testing or data crunching that we've done on this, because this is really meant to be a visual chart. You can see that green line here is the trend in inflation, and that black line is the core CPI, And what trend inflation is supposed to do, it's supposed to be a predictor of CPI. It takes into account the economy, it takes into account economic strength, other financial market variables, and it gives you a different picture on inflation. And you can see many of the times it's actually been a pretty good indicator of where inflation is going to go, right? The big violent turning points, like here in 2009, occurred before the turning points in the actual CPI. Again, here in 2011, the peak in trend inflation occurred before the peak in the core CPI. Again, in 2001 here, big turning point at the top, big turning point at the bottom, both of them being predicted by this trend inflation indicator. And you can see what's happening today as we speak. We've had the trend inflation peak in around the beginning of 2022, while the core CPI has continued higher, right? It printed a record high just last month. That's getting a lot of people very concerned that inflation is not slowing down, and that this red bar that we've discussed throughout this video is actually going to get even bigger, right? Leading to a complete collapse of the financial system. For now, if this trend inflation indicator is telling us perhaps we shouldn't be that doom and gloom about inflation. Potentially it's going to come back down quite rapidly over the next few months and trigger some optimism amongst investors. And the Fed may actually not be that much of a threat anymore because they've reached a point in monetary policy where they are in a restrictive stance. The probability of a recession right now is 100%. So any more tightening, any more aggressiveness would just be a policy mistake because they've done what it takes to create a recession. It's done, but it might be a year, maybe even 2 years before that actually happened. In 2006, they reached a restrictive stance, and the real hard landing, the real recession didn't come until the end of 2007, right? So that was a year and a half, almost 2 years before the restrictive policy ended up playing out for a financial crisis. It could very well be the same today. If they continue tightening over the next few months, it's just a policy mistake because they haven't even seen the effects of their tightening yet and whether or not that's going to cool inflation. Now, I have to say this is an incredibly difficult market environment to navigate. What has been one of the worst moments to own treasury bonds throughout 2022 could turn into one of the most important moments in history to own treasury bonds. What seems to be an environment where stocks have absolutely no chance of going up could actually be one of those moments where we see a once-in-a-generation type of rally. And so that's exactly what we try and represent on our model portfolio, not only in terms of the asset allocation, right? Because if you want to beat the S&P 500, you can't just own the S&P 500. In fact, in our model portfolio, we don't even include the S&P 500 because the other assets and sectors we have more favorable risk rewards. And then, of course, we have to hedge against the risk of this recession here that we just talked about coming into play rapidly. While it could take a year, maybe 2 before playing out, we could be completely wrong on that, and that needs to be reflected through a hedge in our portfolio. So if you want to have access to it, make sure to click on the link down below. Now let's jump to the technicals, right? And let's put up the S&P 500 and the 8-hour chart here. Now, as I'm filming this, the market is on a strong rally into the end of the week, but it's of course encountering some pretty strong resistance here. So we briefly touched upon this last time. Right here, you can see the S&P 500 tagged this 3,900 point level, reversed off of it, and now it's coming back in to retest that trend line. Should we expect the S&P to actually take out this short-term downtrend? One of the things that I like to use as a confirmation tool on the S&P is JNK, right? The high yield bond ETF. It's been giving us some great insights throughout 2022, predicting a lot of moves in the market. You can see the August 2022 high was one of them. You can see as the market was rallying here, right there, JNK was saying, nope, we're going down, and the market's quickly reversed. Same thing again right here in October. You had the market rally, make a higher high, and JNK was saying, nope, we're going down. A lot of the reversals throughout 2022 have been anticipated by the corporate bond ETF JNK, and you can see this is why I'm pretty optimistic about the S&P 500 being able to clear this trend line. JNK is not having a doubt about this rally. So this is promising. In fact, we have some bullish divergence where the market is not yet making a higher high, although perhaps by the time you see this, it will be making a new higher high. But J&K is moving on higher relative to the 26th of October. Now, of course, we'll be watching these developments very carefully. Of course, we'll keep you guys updated on the short-term developments. As we see any type of warning signal or divergence on the market that signals, you can go to gameoftrades.net and you'll be sure to have an update covering that if we see it. Now, I hope you guys enjoyed this episode. If you did, don't forget to smash that like button and click on that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.